If you're thinking about buying a house for the first time, you've probably started to try to learn about the process and what's involved. You've probably come across the term PMI, but maybe you're not exactly sure what this is, whether you need it, and if it's worth it to have it. Well, in today's video, we're diving deep into the world of private mortgage insurance, commonly known as PMI. I'll explain to you what it is, why you need it, and I'll even share my calculator that helps you determine if it is a good deal for you. So let's get started. Hey guys, it's Ron Puro, the loan professor. Private mortgage insurance, or PMI, is a form of insurance that lenders require from borrowers who make a down payment of less than 20% of the home's purchase price. PMI protects lenders in case the borrower defaults on the mortgage, allowing lenders to recover their investment. In short, the idea is that the lenders consider it to be super risky to provide a mortgage loan to someone who is making less than a 20% down payment. The reason this is risky for the lender is that when the lender has to foreclose on the borrower, meaning that the borrower defaulted, the lender is going to have to take possession of the house. Now, the lender doesn't really want to own or manage a property, so they really are just going to want to get rid of it. What this means is no one is fixing up or cleaning the house or adding all the little extra special touches that a seller normally would add to their house before they sell it. So this means that the house is likely going to sell for only about 80% of the original value. So if the borrower put less than 20% down, this means that the mortgage loan balance is going to be more than 80% of the value of the house. So if the house is then selling for only 80% of the original price, the lender is going to lose the difference in that case. Here's a quick example, just to make sure that this is all super clear for you. Let's say that we had an original purchase price of $300,000, and that our borrower decided to make a 3% down payment, so that would be $9,000, and that means that our original loan amount then is going to be $291,000, so that's 97% of $300,000. And so then if this house were to sell at foreclosure, that means that it's going to sell for 80% of $300,000, which would be $240,000. So in this case, that means that the lender is going to likely lose the difference of $291,000 minus $240,000, which is our sell price at 80% of $300,000. And that means that the borrower or the lender is now going to lose $51,000. So banks don't like to take these kind of risks, and so they normally really wouldn't want to make a loan like this. And so starting back in the 1950s, companies came along that were willing to offer the banks insurance that would protect them if a loan did have to be foreclosed on. So in the example above, the private mortgage insurance would reimburse the bank for the $51,000 that the bank lost due to the house being sold as a foreclosure sale. Now, you might be thinking, great, so who pays for this insurance? Well, you may have guessed it, but the borrower actually pays for the PMI. Now, even though this is an extra part of the monthly payment for the borrower, it still can be a win-win because it allows the bank to feel comfortable enough to go ahead and make the loan, and it allows the borrower to be able to buy a house even if they only have around 3 to 5% saved as a down payment. So the other good news is that, at least on a conventional loan, if the loan balance does become less than 80% of the home's appraised value, mortgage insurance can usually be canceled. So this 80% threshold can be reached because the house is either appreciated in value or because the loan balance has been paid down low enough to create an 80% equity position, or it could even be due to a combination of the two. Now we have to take a closer and more specific look to just see if it's actually going to be worth it to you. And in order to do that, we have to use a special calculator that I created. So here you can see our calculator, and what this is just an Excel spreadsheet that I've created, and this allows you to enter in all the variables for your particular scenario, and that'll allow you to compare two scenarios. And so over here in the variables calculator, let's just go over these real quick. You can see that here we enter the purchase price. So in our case, we just said we're going to do $250,000, but you can put whatever number you want to put, whatever house you're looking at. Next is our interest rate. So this interest rate, of course, it could change. It would be a matter of what your loan officer suggested they could give you. So we're going with 6%. Next is the credit score. because the amount that you are charged in PMI is dependent on your credit. So you want to put in what you think your credit score probably is, because like I say, that'll determine what amount you're paying in PMI. The next big variable, of course, is the down payment percentage. They say you maybe put 3%, maybe you're putting 5, maybe 10, or whatever you're putting down, that's what you're putting here. Next, we're going to put in the rent payment, because that's what we assume you're paying now. Where if you haven't bought the house yet, you're probably renting somewhere, and that's what your monthly payment is for your housing expense. But whatever that is, you would put that here. Next, we're putting in the property taxes. This is just the number that the taxes that are being charged for the house that you're looking at. You can get this off of the auditor's site for a specific house, or you could, maybe the realtor could help you if it's a house that's listed, it might be on the listing. That's what it is, just the annual property taxes for the house. Next is homeowner's insurance, which is sometimes called hazard insurance. This is just the insurance on the house in case there's a fire or something like that. And I just threw in the number 1,200 here in the example. You can put any number whatever that number happens to be. This is something you would actually get from an insurance agent. So if you were currently renting and you have renter's insurance, you could ask that insurance agent to give you a quote. They would tell you what the insurance is likely going to be for the house that you're interested in. And again, this is just a ballpark, so I just use 1,200, that's just 100 a month. Next, we have to enter what we think the appreciation is going to be. So I went real conservative here in this example. We're just using 2%. That's a pretty standard number that's pretty common. Most houses or areas in the country are appreciating at least 2% a year. If you're in a really hot area, maybe the appreciation is happening faster. Maybe it's 3 or 4. Again, I just stick to 2 just to be real conservative. If you're in a real slow area, maybe you might think it's only 1%. Next, we want to look at how long we think we have to save up our 20%. So we're at this point in this example, we're saying 48 months or 4 years. But maybe after you look at the numbers, you realize, wow, that's more money than I can actually afford to put aside. I need to stretch out farther. I need 60 months, 5 years, or something like that. But whatever number, you would enter that here. So again, in scenario 1, we're putting 3 or 5% down on a $250 purchase price. So that means we're going to have a loan of $237,500. In scenario 2, of course, we put 20% down. That's giving us a loan of $200,000. Keep in mind, the house that you're interested in buying, today it's worth $250,000. But the house is going to be worth more like $270,000 in 48 months because it's appreciating at 2%. And we're assuming you're looking at the same exact house then as you are today. So therefore, this $20,000 or $200,000 is actually 80% of $270,000, not $250,000. And next over here, you can just see what the percentage is that you have to pay for PMI. Once again, I was saying that takes into account all the factors: your credit score, the percent you're making as a down payment, and what your loan amount is. I wouldn't worry too much about this number. It's just here so that you can see what it is. This number is just multiplied times the loan amount, so that's $237,500, and that number is then divided by 12. That's what gives you what your PMI amount is. Down here you see our P&I, that's principal and interest. That's just what the monthly principal and interest loan payment calculates out to. That's a solid fixed number on a fixed loan. So that's just what that number is. It's just based on the amortization formula. So on a $237,000 loan, in this case at 6%, that's $1,424. And on the $200,000 at 6, it's $1,199. Once again, the PMI, that's what you would have to pay in this scenario based on the credit and so forth. Or if you wait and have 20% down, obviously you won't have PMI, so it's 0. Next is the monthly property taxes. So this is just taking the annual property taxes and then dividing that by 12, because that's going to be added to the monthly payment. It goes as part of the escrow deposit, as part of the payment, so that it's there when the taxes come through. So in our example scenario, that works out to be $225 a month. If you are renting at the moment, you are not paying the property taxes that's paid by the landlord. So that's why it's 0 here. Same for the homeowner's insurance. We said our estimate was $1,200 for the year, so that means it's about $100 per month. That is the payment that goes in the escrow account. Or if you're renting, you are not paying insurance probably on the building itself. Your landlord is probably paying that. You might have renter's insurance. That would only be to cover the contents, your personal property, but it doesn't cover the building itself. That's a separate policy. So that means when we add these variables up on both scenarios, under scenario 1, you would be looking at a payment of $1,880 per month. In scenario 2, we said your rent payment was $1,500 per month. Now we have to say, okay, but now how much do we have to save each month in addition to this rent payment so that we end up with our down payment so that we can put 20% down in 4 years. In this case, that works out to be $865. So under scenario 1, we had to come up with 5% as a down payment. That's $12,500. And then in scenario 2, we're going to have to come up with 20% of $270,000, because that's what the price of the house will be 4 years from now. So that's $54,000. And so the difference on these two is going to be $41,500. And so if you were to add this amount that you have to save each month, $865 plus your rent payment of $1,500, after 48 months, you will have paid out $113,500. Or in scenario 1, if you actually did a loan for 5% down, you were making a monthly payment of $1,880. After 48 months, you would have paid out $90,219. So the difference would be $23,281 here. You paid a little bit more to save up your 20% than you would have if you just done 5. And after 48 months, under scenario 1, your loan balance will be $224,710 in scenario 1. Under scenario 2, you saved up 20%, and so that means you have a loan of $216,000. So the difference in that case is $8,710. And of course, the home value is the same afterwards. It's the same house either way, so it doesn't matter. It's just gone up by 2%, and in this case, that's $270,000. And so the equity position will be 17% after scenario 1. You're going to pay your mortgage down somewhat, and your value is going to go up a little bit, so it's going to be a 17% equity position. Or in scenario 2, of course, you saved up a 20% down payment, so you have an equity position of 20%. So the one thing to look at and understand is that that's not a big drastic difference between scenario 1 and scenario 2 in terms of what you had to actually pay out to kind of get to the same place. But keep in mind, in scenario 1, you actually bought and got into the house now. In scenario 2, you had to wait 4 years or 5 years if you stretch this out 5 years or whatever that time period is. So that's one big difference. Here you're just getting in now. And it's true, you're not quite at 20% equity position, but obviously you're gonna get there in another year or so, just regularly normal payment. So, and of course, depending on the situation and what you're looking at and what your credit is and so forth and how much you have to put down, these numbers all work out to be a little different. But that's why you need this calculator. And like I said, this calculator is just as an Excel spreadsheet. It is completely free to you. If you want to look in the description on this video, there is a link where you can click on to get that. Like I say, it's just completely free, just something you can download to use. So I hope all that makes sense and sheds light on this idea. So in summary, mortgage insurance, or PMI, is a necessary evil for borrowers who simply don't have a 20% down payment. Of course, no one likes to have to pay for something extra as part of their loan payment, but on the other hand, it is a good thing that PMI exists because it does allow people to buy homes that otherwise wouldn't be able to do so. And lastly, PMI can usually be canceled once you've reached an 80% equity position, either by, again, appreciation, or by paying down the loan balance, or by a combination of those two. I hope you enjoyed this video, and I hope you found it helpful. See you next time. Happy home buying.